Everybody, we are here with Anna Benz, Chief Fulfillment Officer with Movement Mortgage, and in layman's terms, that means all underwriting and closing functions funnel up to you, right? So
And
you're at the
processing.
top of the pyramid.
Yes, that is accurate.
And one of your specialties in wheelhouse is what they call the non-QM loans, right?
Yes.
And Kathy, you want to help kind of explain what the non-QM loans are for our realtors and
Yeah,
buyers?
so non-QM for us really is anybody that doesn't fit into the conventional box of assets, income, what debt to income ratio, whatever that is. We go into what we call the non-QM space, where there's great loan product that helps self-employed borrowers, investors, and other people, actually, as we'll find out, with some new product that we have coming, so that they are still able to buy a house, maybe for more than what they would qualify for based on their tax returns.
Absolutely. I mean,
Yeah.
most self-employed borrowers, right, they have an amazing CPA, and part of the CPA's job or the tax planner's job is to help them minimize their tax liability, which is great when it comes to tax time, but not so beneficial when it comes to applying for a mortgage.
Exactly.
So we find alternative ways to get borrowers qualified. And a perfect example is, get rid of the 1040s. We're not even going to look at the borrower's 1040s. We're going to just look at the borrower's 12 months of business tax returns and see what their cash flow was and equate a qualifying income from that. That's just one area that you can help get a borrower qualified that they normally traditionally would not be able to qualify.
Right.
A 1099 borrower, right? All of our real estate agent partners, that's a great example of somebody who's 1099'd, where we would just take their 1099 and apply a very small expense ratio to that 1099. Or there's the asset depletion, where you would take a borrower's combined assets and divide it by a certain amount of time frame, and that is what you would say their qualifying income is. That borrower could be 20 years old or 70 years old. It doesn't matter if they just have the asset. Now, you can use that asset as a standalone, where that is the only source of income you're using to qualify the borrower, or you can combine it with additional sources of income. Say the borrower has a job and they have W-2 pay stub. They also maybe have retirement income, but they also need to pull asset depletion in to get them across that DTI threshold. That would be the asset depletion. And then there's DSCR, which is the debt service coverage ratio, which is similar to a commercial loan where the borrower, I don't care what the borrower's personal DTI is. What I'm looking at is the property that the borrower wants to purchase or that already owns and wants to refinance. What is the cash flow? What is the income earning potential on that property, as opposed to what the PITIA is, the liability is on that property? So, some of our borrowers who already own numerous rental properties, sometimes they find it hard to qualify from a traditional format of looking at their 1040s or their tax returns. So going into the DSCR space is another wonderful way to qualify. I think most people think non-QM and think it's just for an expanded credit policy, which it is, but the majority of our non-QM loans are done full doc. And that's surprising when you think about, well, why would you go full doc? It's because it's a pricing pickup, right? We don't have the same pricing hits that you do in the agency space. So if you're doing a second home or an investment property, you can oftentimes go into the non-QM space and get better pricing,
A better
which is
rate.
so powerful. Yes.
Yes.
Right, yeah, I mean, I've noticed that. I mean, the traditional Fannie Freddie type loans, if you're putting 20-25% down, their rates are going to be higher than what's the non-QM. One thing I did kind of curious about, and I was trying to think on the non-QM and movement, it seems to be shortly after COVID that a lot of this became what I call in-house. So, right, this started more of a broker channel, and then we kind of now underwrite the majority of it.
Yes.
And that's what I really like about movement and kind of experiencing different sizes and different companies. For us, right, I mean, it's almost everything is in-house. And
Everything is in-house.
There's not anything we can't underwrite, and we don't
Yeah.
control the process, and that's a huge win.
It's a powerful advantage for our loan officers to be able to go to the decision maker. When you're brokering it out, you're relying on a third-party entity to make the final decision. You have direct access to the decision makers to be able to say, this is what we're looking at. This is the story behind this loan. How do we get this loan across the finish line? And so that was really important to me as I was developing the non-agency department for Movement Mortgage, that we are able to be the final decision maker on a lot of those transactions so that you don't have to broker it out. It also allows you the ability to, when it's in-house, if you come to me and you're in a rush situation, a loan fell out someplace else, they weren't able to close it. They're coming to you at the last minute and saying, Pete, Kathy, can you help us get this loan across the finish line? You can call us and say, hey, I need this done in 7 days. And we can pull the triggers to make that happen for you because we're here to support you.
And we can attest
Yeah, we
that
do.
absolutely
Yes.
happens, particularly in that non-QM space where
Yes.
things don't go right, or because another lender tried to broker the loan. And
Yeah.
I don't think have you tried to broker a loan?
I'd stay away from it. If I can't control it, I stay away from it.
I lived in that world for a little bit. It's why I have to color my hair
Yeah.
so often because it gave me a lot of gray hairs. And we like our control.
Yeah.
So it just keeps the control of the loan
Yeah.
with us and
Yeah.
y'all here.
And
that
especially,
makes a huge difference.
I think with you too, Pete, if he has a concern about a file as he's talking to the borrower, he's going to pick up the phone and call and say, this is what I have. Can we or can't we do this, right? Same thing with you. If you have a concern, you're going to pick up the phone and vet it out up front and be able to talk to somebody who can give you an honest answer because we know at the end of the day, your borrower is on the other end of that transaction and you
Right.
want to be able to work with that borrower from a place of integrity.
Right.
100%. And that's what makes, Movement such a great place for those non-QM.
Yes.
There's not a loan we can't do.
Yeah. We love that.
The other thing that I would say comparatively from where we've been is the number of options that we have in each of the different non-QM spaces, whether it's a need for better pricing, different down payments, different calculations on income, like the asset depletion. You have 120 months,
60
80
months.
60 months when you need to squeeze that
Yeah.
income out. So the variety of what is here is also very unique, I think, to Movement.
Yes, and I would say that's really important because the borrowers that you support on a daily basis have unique stories. And so in order to be able to really serve a larger base, we needed to have programs that could support those types of different stories. Instead of, here's the box, you either fit in the box or you don't, right?
Right.
On top of our expansive guidelines, we also close a lot of our non-QM loans with an approved exception. So 28% on average of our loans are approved in the non-QM space with an exception, which is fantastic. And the reason that we're able to do that is because our partners really want to be good partners to us. We can pick up the phone, call them, and say, this is the story, this is the situation, make it make sense. And if we've got strong compensating factors, usually the answer is yes, we can work with you on that. Another thing I think is really interesting is that most other competitors have some of the competitors that we work with, but the version of that they have is the out-of-the-box, off-the-shelf version. Our version is not out-of-the-box, off-the-shelf in many of our cases. What we usually do is we will write our own guidelines, present them to the investor and say, this is what we feel best serves our customers. This is what we feel there is a niche and a need for. Are you willing to accept our guidelines? So that is a distinct advantage that we have.
I learned something new today.
Yeah. So I love that we can do that. And
Yeah.
non-QM is my love language. I could talk about it for days. And the investors that we partner with know that about us. They know that we want to produce good loans and be really good partners across the board. And that allows us to be able to do things that some of our competitors cannot do.
And speaking of that, I think, one of the things where we differ is what I notice here is there's constantly some kind of rate special. Somebody's coming to us
Yeah.
and saying, you want some loans, and we get great pricing. In general, I'm sure the difference between your Fannie and Freddie and the non-QM seems to have shrunk.
Yes.
It's not near as big as it used to be, and then you come up with some specials,
Yeah.
and it's, equal to the best rates.
Yeah, and that is something that we've built over the years, right? When you produce a good product, people want to come to you. So we have investors coming to us wanting to buy the product that we're producing. They want to buy that mortgage because they know that we've done our due diligence and we are doing the hard work up front to make sure that we're producing a very good mortgage. And when you're producing that and you have the reputation of that in the industry, it allows other investors to come knocking on your door saying, we want we want in. So
Right.
that is another advantage that we have is we're very proud of the fact that we're good at it. We do a really good job at doing non-QM and jumbo, and we are very, very proud of that.
Thank you. It's been a very informative chat.
You're welcome. Thanks for having me.